Canada and Mexico are furious because Trump imposed tariffs on them. Europe is terrified because Trump keeps hinting.
Single day, more than $1 trillion worth of yen exchanges hands.
The Bank of Japan is more in charge of the direction now.
This as President Trump keeps on talking about tariffs being imposed on April 2nd.
Go incredibly wrong. You'll lose money both on the stock side.
Things like that. There is a period of transition because what we're doing is very big.
Canada and Mexico are furious after President Trump imposed tariffs on them. Europe is nervous because Trump keeps suggesting that the U.S. might not assist in the event of a war. And now Japan is the latest nation feeling the heat. Every day, more than $1 trillion worth of yen exchanges hands. It seems like the Bank of Japan is becoming more influential in steering the direction of the country's economy. This comes as Trump continues to talk about tariffs being imposed, particularly on April 2nd. If things go wrong, both the stock market and the economy could take a serious hit. It's not an easy situation. And there's a significant period of transition happening as the U.S. makes these bold moves. Japan, which is known as the Far East's high-tech hub, is also the financial stronghold of the U.S., holding a vast amount of U.S. Treasury bonds. Tokyo has been Washington's most consistent bond buyer for decades, and its recent actions to break the dollar monopoly have sparked a great deal of concern. American tariffs have prompted Japan to shake up the U.S. markets by selling off a huge portion of its treasury bonds. The U.S. is now feeling the effects of losing its financial umbrella with Japan's decision, causing the country's global position to weaken. We are now diving deeper into the crisis caused by these bond sales and what it means for the future of the dollar's dominance. But before we get into all of that, don't forget to subscribe to our channel, turn on notifications, and hit the like button so you can stay updated with our latest content. Let's dive into the issue at hand. Japan's decision to move its foreign exchange reserves into other currencies is even more significant when combined with the fact that the U.S. stock market has recently lost more than $1.7 trillion in total by 2024. Tokyo is reported to hold over $1 trillion in U.S. bonds, and if Japan fully unleashes this bond-selling weapon, it could rattle many parts of the U.S. economy, from interest rates to employment. For decades, Japan was one of the largest buyers of U.S. Treasury bonds. These bonds have been crucial for the U.S. to finance its public debt. But now, leaks from the Japanese Finance Ministry suggest that Japan has sold off a significant portion of its holdings, leading to speculation about the long-term effects on the dollar's global prestige. The question is, could this massive sale of bonds really undermine the dollar? For years, Japan has been one of the biggest supporters of the U.S. dollar, investing its trade surplus in U.S. Treasury bonds. But after Trump's administration began imposing tariffs, Japan started using this financial weapon in a more direct way. They are now saying, if you impose tariffs against us, we will sell your bonds. This marks a new breaking point in the relations between the U.S. and Japan. During Trump's previous presidential term, he was known for his protectionist trade policies. Under the America First slogan, his approach led to Japan being one of the hardest-hit countries by these tariffs, particularly in industries like automobiles, steel, and technology. Japan has long been one of the most significant supporters of the U.S. dollar, investing a substantial portion of its trade surplus in U.S. Treasury bonds. For decades, Japan was the most consistent bond buyer for the U.S., ensuring that Washington could borrow at relatively low interest rates. These bonds have played a crucial role in financing the U.S. public debt, allowing the U.S. to maintain its global financial dominance. However, with the rise of protectionist policies under the Trump administration, Japan has begun to rethink its financial strategy, and its actions are now signaling a major shift in the relationship between the two countries. The United States has consistently relied on foreign investors like Japan to buy its debt, which has kept interest rates low and the economy moving forward. But recent developments suggest that Japan is starting to reduce its holdings of U.S. Treasury bonds. This move is part of Japan's broader strategy to diversify its financial assets and reduce its dependence on the U.S. dollar. The leaks from Japan's finance ministry indicate that the country is scaling back its bond holdings, potentially to undermine the dollar's dominance in global trade. For Japan, the decision to reduce its exposure to U.S. bonds is not just a reaction to Trump's tariffs. It is a calculated move to bring a powerful financial weapon to the table. By selling off U.S. bonds, Japan can affect U.S. interest rates and, in turn, weaken the value of the dollar. The effect of such a move would ripple throughout the global economy, potentially raising interest rates and slowing economic growth in the U.S. It could also lead to a sharp depreciation in the stock market, as investors pull back from riskier assets and shift towards safer investments like bonds. What makes this situation even more critical is the size of Japan's bond holdings. Tokyo is reported to hold over $1 trillion in U.S. Treasury bonds. If Japan were to sell off even a portion of these bonds, it could send shockwaves through the financial markets. The sale of such a vast amount of U.S. bonds could lead to a significant increase in U.S. borrowing costs, slowing economic growth, and making it more difficult for the U.S. to finance its public debt. While Japan has not made any official statements about abandoning the dollar, the signs are clear Japan is preparing for a multipolar financial world. By diversifying its holdings into other assets such as the euro, the British pound, and gold, Japan is positioning itself to move away from the U.S. dollar's monopoly. This gradual shift represents a long-term strategy to reduce the risks associated with holding large amounts of U.S. debt. This move by Japan also comes at a time when other countries, like China, are also taking steps to diversify away from the dollar. China, in particular, has been working to reduce its reliance on the dollar by increasing its holdings of gold and other foreign currencies. Together, these moves signal a shift toward a more diversified global financial system where the U.S. dollar is no longer the undisputed reserve currency. The question now is whether Japan's actions will be enough to significantly challenge the dollar's dominance or whether the U.S. will find a way to counteract this shift. As Japan continues to sell off its U.S. Treasury bonds, the rest of the world is watching closely to see how the U.S. responds to this growing challenge. The recent developments surrounding Japan's financial strategy represent a critical shift in the global economic landscape, particularly when it comes to the U.S. dollar. For decades, Japan has played a pivotal role in keeping the U.S. economy afloat by purchasing treasury bonds, helping to fund the country's massive public debt. The United States has long relied on foreign buyers, like Japan, to maintain its financial stability, and these bond purchases have allowed Washington to borrow at lower interest rates. However, Japan's growing reluctance to continue buying U.S. bonds is raising alarm bells in financial circles, as it signals a fundamental change in the balance of global financial power. Japan's decision to reduce its bond holdings is not just a reaction to Trump's protectionist policies, but also part of a broader trend in the global economy. As Japan begins to diversify its foreign exchange reserves and move away from the U.S. dollar, it's sending a clear message. The era of dollar dominance may be coming to an end. Japan has started to shift its focus to other currencies, such as the euro and the British pound, as well as more stable commodities like gold. This shift is part of Japan's strategy to prepare for a more multipolar financial system where no single currency, including the dollar, holds absolute dominance. The impact of Japan's decision to sell U.S. Treasury bonds would be far-reaching. If Japan were to sell off even a fraction of its $1 trillion in bonds, the U.S. could face a significant rise in interest rates, This would make borrowing more expensive for the U.S. government and could slow down the country's economic growth. For investors, rising interest rates on U.S. bonds could lead to a sell-off in the stock market, as investors may see less value in holding risky assets like stocks when they can get higher returns from bonds. The resulting drop in the stock market could have severe consequences for U.S. businesses, consumer confidence, and the overall economy. Additionally, Japan's move could weaken the value of the U.S. dollar, which has been the world's primary reserve currency for decades. A weaker dollar could make American exports cheaper, but it would also make imports more expensive, contributing to inflation. The consequences of a weaker dollar would be felt globally, as many countries hold significant amounts of U.S. dollar-denominated assets. If Japan and other nations continue to reduce their dollar holdings, it could create a domino effect, with other countries following suit and diversifying away from the dollar. Japan's decision to move away from the dollar is not a new development. For years, Japan has expressed a desire to reduce its reliance on the U.S. dollar. This has been particularly evident in the way Japan has increasingly invested in other assets, such as gold and foreign currencies. The move to sell off U.S. Treasury bonds represents the most dramatic step yet in Japan's efforts to wean itself off the dollar. This shift also comes at a time when other countries, such as China, are taking similar steps to reduce their reliance on the U.S. dollar, signaling a broader trend in the global economy toward a more diversified financial system. The question now is how the U.S. will respond to this growing challenge. Will Washington take steps to counteract Japan's bond sales, or will it allow Japan to continue its gradual abandonment of the dollar? The U.S. has historically maintained its position as the world's leading financial power, but Japan's actions suggest that this dominance may be slipping. In the coming years, the global financial system could look very different, with the dollar playing a less central role in international trade and finance. The consequences of Japan's financial moves are not limited to just the U.S. economy. The global financial system could feel the tremors if Japan continues to sell off its U.S. Treasury bonds. The U.S. Treasury has long been able to borrow at low interest rates, largely because countries like Japan have bought vast amounts of U.S. debt. These countries have been able to do this because the U.S. dollar has held its position as the world's dominant reserve currency. But as Japan diversifies away from the dollar and reduces its bond holdings, it raises the possibility that the U.S. could face higher borrowing costs in the future. If Japan's bond sales escalate, it would likely lead to a spike in U.S. interest rates. This would not only affect the U.S. government's ability to finance its debt, but also impact American consumers and businesses. For consumers, higher interest rates mean more expensive loans for things like homes, cars, and credit cards. For businesses, higher borrowing costs could reduce investment and slow down growth. The stock market could also feel the effects, as rising interest rates would make bonds more attractive compared to stocks, leading investors to sell off their equities in favor of safer bond investments. The U.S. Treasury bond market is one of the largest and most liquid markets in the world, and any disruption to this market would have ripple effects across global financial markets. If Japan and other countries begin selling off their U.S. bond holdings, it could lead to a decrease in the demand for U.S. debt, making it more expensive for the U.S. government to borrow money. This, in turn, could lead to a rise in global interest rates, as investors seek safer assets like bonds. The U.S. dollar could also face pressure as the demand for the dollar as a global reserve currency decreases. This shift away from the dollar could also create a domino effect, where other countries follow Japan's lead and begin to reduce their reliance on the U.S. dollar. China, for example, has already taken steps to diversify away from the dollar. by increasing its holdings of gold and other currencies. The European Union has also been exploring alternatives to the dollar, particularly as tensions between the U.S. and Europe rise over trade and other issues. If more countries start moving away from the dollar, it could ultimately weaken the U.S. position in global finance. Japan's move to reduce its dollar holdings is not just a financial strategy, it is also a response to the U.S. growing protectionism and its trade policies under President Trump. The tariffs imposed on Japan, particularly in the automotive and technology sectors, have strained relations between the two countries. Japan initially responded diplomatically, protesting the tariffs, and even signaling that it might impose retaliatory tariffs on American products. However, it is Japan's move in the financial markets that is sending the strongest signal to Washington that Tokyo is willing to use its financial influence to push back against U.S. policies. Japan's actions are a clear sign that it is no longer content to simply be a passive player in the U.S. dominated global financial system. As Japan continues to reduce its holdings of U.S. Treasury bonds and diversify into other currencies and assets, it is signaling that the dollar's dominance is being tested. Japan is preparing for a more multipolar financial system, where no single currency holds all the power. This shift is a significant challenge to the U.S., which has relied on the dollar's dominance for decades to maintain its economic and geopolitical influence. If Japan and other countries continue to reduce their reliance on the dollar, it could have far-reaching implications for the U.S.'s ability to influence global financial markets and maintain its economic power. The Trump administration may be forced to confront this challenge head-on, either by adjusting its trade policies or by trying to persuade countries like Japan to maintain their support for the dollar. As the world continues to watch Japan's shift away from the U.S. dollar, the broader geopolitical implications are starting to unfold. Japan's decision to reduce its reliance on the U.S. dollar could be seen as a direct challenge to the U.S. financial power, which has long been tied to the dominance of the dollar in global markets. While Japan's actions are a response to Trump's trade policies, they also reflect a larger global trend towards diversification away from the dollar. Countries like China, Russia, and even some European nations are exploring alternatives to the dollar, a movement that has been gaining traction in recent years. One of the most significant impacts of Japan's decision is on the global currency markets. The U.S. dollar has been the world's primary reserve currency since the end of World War II, and its dominance has allowed the U.S. to exert considerable influence over global finance. However, Japan's move to sell U.S. Treasury bonds and diversify its reserves into other currencies like the euro, the British pound, and even gold signals that the U.S. may not be able to rely on the dollar's dominance indefinitely. If other countries follow Japan's lead, it could gradually erode the dollar's position as the global reserve currency, leading to a more multipolar financial system. The question then arises, what will happen if the dollar's dominance begins to wane? A move away from the dollar could have profound consequences for the U.S. economy. For one, it could lead to higher interest rates in the U.S., as the country would no longer be able to borrow at such low costs. This would put additional pressure on U.S. consumers and businesses, as loans for things like homes, cars, and credit cards would become more expensive. The stock market could also take a hit, as investors might choose to move their money into other currencies or assets that are seen as safer than the U.S. dollar. Another potential consequence of Japan's move away from the dollar is the impact it could have on U.S. global influence. The dollar has not only been the dominant currency in global trade, but it has also been a key tool for the U.S. to exert influence over other nations. Countries that hold large amounts of U.S. Treasury bonds are essentially supporting the U.S. in its financial and geopolitical efforts. If Japan and other countries begin to reduce their dollar holdings, the U.S. may find it harder to maintain its influence on the global stage. This shift in global financial dynamics is not just about Japan or the U.S. It's part of a larger trend of countries looking to reduce their dependence on the U.S. dollar and the U.S. dominated financial system. China, in particular, has been actively working to internationalize its currency, the yuan, and reduce its reliance on the dollar. Russia has also been diversifying its foreign exchange reserves away from the dollar, particularly since the U.S. imposed sanctions on the country. Even some European nations are beginning to explore alternatives to the dollar, particularly in light of the trade tensions with the U.S. The move by Japan is also a sign of the growing importance of regional economic and financial cooperation, as countries like Japan, China, and Russia increasingly look to work together to create a more diversified and balanced global financial system. The U.S. may find itself at a disadvantage. The dollar has long been the anchor of the global financial system, but if other countries start to move away from it, the U.S. could face a future where its influence in global finance is diminished. The global financial system is on the brink of significant transformation, and Japan's shift away from the U.S. dollar is a crucial part of this change. As Tokyo continues to reduce its holdings of U.S. Treasury bonds, it is signaling that the global financial order is evolving. The U.S. dollar, long seen as the unchallenged global reserve currency, is now facing increased competition from other currencies like the euro, the yen, and even gold-backed assets. This growing diversification is not just a reaction to Trump's protectionist policies, but also part of a broader shift in global economic power. Japan's move to sell U.S. Treasury bonds could have far-reaching consequences, not just for the U.S., but for global markets as a whole. If Japan, along with other countries like China, continues to sell off their U.S. debt, the U.S. could face rising interest rates. This would make borrowing more expensive for the U.S. government, as well as for consumers and businesses. Higher interest rates would likely slow down the economy, as the cost of credit increases and spending decreases. For the stock market, rising interest rates would make bonds more attractive to investors, which could lead to a significant sell-off in equities. Moreover, the impact of Japan's actions on the U.S. stock market is already being felt. In recent weeks, the stock market has taken a hit, losing trillions of dollars in value. Technology stocks, in particular, have been hit hard, with companies like Tesla, Apple, and Nvidia losing billions of dollars in market value. This reflects broader investor concern that the U.S. is facing a period of economic instability, which is being exacerbated by the unpredictable nature of Trump's trade policies and tariffs. The loss of $1.7 trillion from the U.S. stock market is a stark reminder that these trade wars are having a real and tangible impact on the U.S. economy. The stock market's instability has raised concerns among analysts and economists, many of whom believe that the U.S. could be heading toward a recession, while Trump's administration continues to claim that these trade wars will ultimately lead to economic growth. Many investors are skeptical. As tariffs continue to rise and tensions with trading partners increase, the risk of a slowdown in global trade is growing. With major economies like Japan, China, Canada, and the European Union retaliating with tariffs of their own, it is becoming increasingly difficult for the U.S. to maintain its economic momentum. As Japan and other countries reduce their reliance on the U.S. dollar, the global trade landscape is shifting. The dollar, which has been the dominant currency in global trade for decades, is facing a growing challenge from other currencies. The euro and the yen, in particular, are gaining ground as alternatives to the dollar. In addition, countries like China and Russia are increasingly turning to alternative forms of payment, such as the yuan and gold-backed assets. These developments signal that the global financial system is becoming more multipolar, with several currencies vying for dominance. This shift away from the U.S. dollar could have profound implications for the U.S. economy. If the dollar loses its status as the world's primary reserve currency, the U.S. could face higher borrowing costs, reduced influence over global financial markets, and a diminished role in international trade. For now, the U.S. remains the world's largest economy, but as Japan, China, and other nations take steps to diversify their financial assets, the dollar's position is being tested like never before. As Japan continues to sell off U.S. Treasury bonds and shift its foreign exchange reserves into other currencies, it is clear that the global financial system is changing. The U.S. will have to adapt to this new reality or risk losing its economic and geopolitical dominance. The question now is whether the U.S. will be able to maintain its position in the face of these challenges, or whether it will have to find a new way to navigate the shifting global financial landscape. As the U.S. continues to face significant pressure from both domestic and international sources, the potential for a massive shift in the global financial landscape becomes more evident. Japan's gradual abandonment of the dollar, coupled with China's actions to reduce its holdings of U.S. Treasury bonds, has created a situation where the U.S. could soon face an existential challenge to its financial hegemony. The idea that two of the world's largest economies, Japan and China, could collectively shift away from the U.S. dollar is a game changer. If this happens, it could significantly affect the U.S. ability to borrow at favorable rates, potentially causing long-term economic repercussions for the country. The immediate impact of Japan's bond sales has been seen in the volatility of the U.S. stock market. Recent weeks have witnessed a dramatic loss of value, with the U.S. market shedding an estimated $1.7 trillion. In particular, the technology sector has been hit hardest, as investors become increasingly concerned about the uncertainty surrounding the U.S. as trade policies and their effect on global markets. Stocks like Tesla, Apple, and Nvidia, which had been market leaders, saw sharp declines, further fueling concerns about a potential recession. The volatility in the stock market is directly tied to the broader trade war between the U.S. and its major trading partners, with tariffs and retaliatory measures contributing to a tightening of financial conditions. These developments have raised alarms among analysts, who argue that the U.S. is not prepared for the long-term consequences of these trade policies. While President Trump's administration maintains that tariffs are a necessary tool to protect American interests and revitalize the U.S. economy, many financial experts are worried about the effects of these policies on both the stock market and the broader economy. Higher interest rates resulting from a reduced demand for U.S. Treasury bonds could slow down economic growth, making it more difficult for consumers to borrow money and for businesses to invest. If the U.S. stock market continues to decline, it could trigger a wave of panic, selling, and further depress the economy. The rise in tariffs and the resulting market instability are creating a perfect storm of economic challenges for the U.S. as countries like Japan, Canada, Mexico, China, and the European Union announce their own retaliatory tariffs. The U.S. faces the growing risk of being isolated in the global market. The trade war is escalating, with entire regions being pulled into tariff disputes. Canada and Mexico, in particular, have introduced tariffs on U.S. products, including steel, aluminum, and agricultural goods. Europe has also raised tariffs on American goods, such as whiskey, motorcycles, and agricultural products. The growing sense of uncertainty is not limited to the stock market alone. Analysts are concerned that the ongoing trade wars could lead to inflationary pressures in the U.S. as the cost of imports rises due to higher tariffs. In particular, the prices of goods like electronics, Automobiles and agricultural products could increase, further straining American consumers. These price hikes could lead to reduced spending power, particularly for middle-class families who are already feeling the effects of a slower economy. The recent losses in the U.S. stock market, combined with the ongoing trade war, are signaling that the U.S. economy may be entering a period of stagnation. The Trump administration's pro-growth stance has not been enough to counteract the effects of the trade wars, and many analysts now believe that a recession is becoming increasingly likely. The broader global economic slowdown, combined with the U.S.'s ongoing tariff disputes, has created an environment of heightened uncertainty. In addition to the economic concerns, there are significant geopolitical ramifications to the shift away from the dollar. The U.S. has long used the dollar as a tool of influence, exerting pressure on countries through sanctions and trade policies. However, if more countries begin to diversify away from the dollar and embrace alternative currencies, it could diminish the U.S.'s geopolitical power. Japan's decision to sell off U.S. Treasury bonds and reduce its reliance on the dollar is a direct challenge to the U.S. its ability to use the dollar as a lever in international relations. As the situation evolves, the U.S. may find itself in a difficult position, with both its economy and global influence at risk. Japan, China, and other countries are sending a clear message that they are no longer willing to be passive players in the U.S. dominated financial system. If the U.S. is to maintain its global financial position, it may need to adjust its approach to trade and its reliance on tariffs as a tool for economic growth. As Japan and China take steps to move away from the U.S. dollar, the geopolitical balance in East Asia could shift significantly. Both countries have been making moves to diversify their reserves away from U.S. Treasury bonds, signaling that they no longer view the dollar as the unshakable foundation of global finance. Japan's recent actions to sell off U.S. bonds and reduce its holdings in dollars reflect the growing sentiment in Asia that it is time to break free from the U.S. dominated financial system. This shift could have profound consequences, not only for the U.S. economy but also for global trade and security. Japan's decision to sell off U.S. Treasury bonds is not without risks. The Japanese government is fully aware that a large-scale sell-off could cause a significant depreciation in the value of U.S. bonds, leading to a potential loss in the value of its own reserves. Yet, Japan appears willing to take this risk, possibly because the larger threat to its own economy comes from remaining tied too closely to the U.S. Japan's leadership likely sees this as a necessary step to protect its long-term financial stability and reduce its exposure to U.S. economic volatility, which has been exacerbated by Trump's unpredictable trade policies and tariffs. While Japan's move could hurt its own financial portfolio in the short term, it might ultimately give the country more control over its economic future. By reducing its dependency on the U.S. dollar, Japan is preparing for a more multipolar world, where economic and financial power is more evenly distributed. This shift could lead to increased economic cooperation within Asia, as countries like Japan, China, and South Korea begin to forge closer ties to create a regional economic bloc less reliant on U.S. financial influence. This trend toward a more diversified financial system is also reflected in the growing importance of the Chinese yuan. China, the world's second-largest economy, has been actively promoting the yuan as an alternative to the U.S. dollar, especially in international trade. Through initiatives like the Belt and Road Initiative, BRI, China is working to establish its currency as a viable alternative for global transactions. The yuan's increasing role in global trade has already begun to challenge the dollar's dominance. And if Japan follows through with its bond sell-off, it could hasten the shift toward a new, more diversified financial system. However, Japan's actions are not solely focused on currency diversification. The country is also looking to strengthen its defense capabilities. In light of growing security concerns in the region, Japan's decision to reduce its reliance on the U.S. dollar and diversify its financial assets could be seen as part of a broader strategy to increase its geopolitical independence. The U.S. has long been Japan's security partner, with the two countries sharing a mutual defense pact. But as Japan's leadership grows more wary of U.S. actions, particularly under Trump's administration, there is a growing sense that Japan needs to assert its own autonomy in both economic and defense matters. In response to the U.S. increasingly protectionist policies, Japan may begin to pursue a more independent foreign policy, one that seeks to strengthen its ties with other Asian powers and reduce its dependence on the U.S. This could involve increased defense spending and a greater focus on regional security partnerships. As Japan's leadership grows more self-confident, the country could also seek to expand its influence in international organizations and multilateral forums, further diminishing the U.S. ability to dictate the terms of global trade and security. This shift could also have consequences for U.S. military presence in Asia. While the U.S. has long had a strong military presence in the region, Japan's growing independence could lead to a re-evaluation of this relationship. If Japan feels that it can handle its own security needs without U.S. intervention, it could push for a reduction in U.S. military presence on its soil. This would be a significant blow to the U.S. ability to project power in the Pacific region and could lead to a reshuffling of alliances and security arrangements in East Asia. The geopolitical ramifications of Japan's move away from the dollar are still unfolding, but it is clear that this is a pivotal moment in the country's history. Japan is no longer willing to remain a passive player in the U.S. dominated global order. As it diversifies its financial assets and seeks greater autonomy in defense matters, Japan is positioning itself as a more independent global power.